Hi, I'm James. The next 5 minutes might actually define the way your trading career turns out in the end. If you learn and understand the principles that I'm going to cover here in the next 5 minutes, unprompted, unscripted, just going to go through the notes with you, and keep the notes, write them down, keep them in a safe place, read them from time to time. But literally, if you master this and forget everything else, forget all the technicals, all the fundamental analysis, all the other stuff that you've learned about trading, and you master this, you will be much more successful in your trading than otherwise. If you don't pay attention to these principles, these points, these factors, these stumbling blocks to your trading, you will probably fail. In fact, I'd say you will certainly fail. So moving on from the doom and gloom, I'm going to go through the notes, and I want you to pay very careful attention to what I'm saying, and I want you to make your own notes, write them down, put them on the back of a cigarette box, put them somewhere, make sure that you adhere to them and understand them. Let's go through. So trade like a grown-up. Discipline, defense, and a bit of devilry. And the first point is framing the game. Trading is not gambling unless you're a gambler. So first question you need to ask yourself is, are you gambling? Are you trying to make a quick buck? Are you risking more than you can afford to lose? Are you addicted to trading? All sorts of important questions. But if you do find yourself gambling, and you are a gambler, if that's what you are, then you probably won't do very well at trading at all. You might get lucky from time to time, but mostly you're going to end up losing. Let's zoom in a wee bit and carry on reading. Trading is deceptively simple. Buy low, sell high, or short high, buy back lower. Easy to say, fatal to underestimate. The market is a game of probabilities wrapped up in uncertainty and powered by emotion. A winning system with a losing mindset is a losing system. Quote from Dr. David Paul. And the key takeaway here is, you are not here to be right. You're here to survive. Survive long enough to be right enough. Your weapon is process, your process, and your shield is risk management. Your undoing is normally your ego. And we all know what that's about. Let's carry on. Money management, ammunition control. I suppose there's a war theme going on here in a little way. Position sizing, never risk more than 1 to 2% of your capital on a single position. That may vary depending on your risk tolerance or your goals or your ambitions for your trading account. But if you're not gambling and you want this to be a long-term career, this is a pretty good guideline. I err more towards the 1% total of my capital. Think in terms of risk units and not trade size. A big position on a strong setup is still valid if it fits your risk unit, your profile. Next, DCA, dollar cost averaging, in and out. Don't blow your powder all at once again with the war theme. Enter in measured clips. Let the market confirm your view. What I do is I normally scale in with about a 20 or 25% position, my initial entry. And if the market moves in my favor, I may add to that winning position or just accept that I'm going to make a smaller profit with a smaller position. If the market moves against my position, in other words, perhaps I'm short and the market starts moving up, I've still got more ammo to add to my short position. That is, of course, unless we break the line in the sand. The line in the sand is the place on your chart where you know that you're wrong or you're most likely wrong, and that's where you should exit or hedge your position. So don't blow your powder all at once. Enter in measured clips. Let the market confirm your view, and exit the same way. Scale out methodically. Lock in gains while leaving room to run. And you'll often notice, if you're in my private group, you'll see that we get into a trade gradually, and we also exit a trade gradually. I don't take all of my profits off at once. I leave some size on in case the market or the trend continues in my favor. So exit the same way, scale out methodically, lock in gains, but leave room to run. Pretty simple. The danger of clustering. Now, this is an important factor that you may not have considered, and here's an illustration. Place 5 trades in a row. Each one risks 3%, a little bit higher than we should be using. 3 losses equals negative 9%. 2 more losses, negative 15%. You're rattled, emotional, and now you're trading to get it all back. You're revenge trading. You want that money back. You don't want to lose it. Clustering is when multiple losses or wins occur in quick succession. Statistically, there's no particular reason why this should happen, but there's also no reason why it shouldn't happen. So statistically, we will get clusters from time to time due to the random nature of the market. In a high cluster environment, even a good system can suffer. Let me repeat that. In a high cluster environment, even a good trading system can suffer. It does not mean your trading system is invalid, that you should throw it out or change systems. It simply means that you need to manage your risk properly and correctly during those cluster-ish periods. The solution is proper risk limits and an awareness of the market regime. Reduce size or step back when variance spikes. So the rule of thumb is when clustered losses appear, assume that the market has changed or you have, stop, reassess, reevaluate, check out your system. Normally, your system will be fine. I promise you that. It's not normally the trading system that's the problem. Most trading systems work in some markets and fail in other markets, and a good trader will be able to adjust the trading system as they go along. Most good traders don't use mechanical trading systems, but rather rely on their expertise, their knowledge of the market, patterns that the market normally adheres to, the nature of different and the personality of different instruments that you may be trading, and just overall experience with trading market patterns and candle setups. Yes, I lost my train of thought there. I had a phone call. As I said, this is unscripted, and I'm just doing it to sort of illustrate this book. But the rule of thumb is when clustered losses appear, assume that the market has changed, or you have. Stop and reassess. And as I said earlier, normally it's not your trading system that's the problem. It's just the matter of managing your risk during those clustered markets, and they do happen from time to time. All right, so number 3, the art of not dying is the art of risk management. The line in the sand. It's a really important concept, this, which I teach in my Swing Trading Blueprint course. Let's read through it here. The line in the sand. Every trade should have a clear invalidation point. In other words, a price level on your chart where you know if the price crosses there or closes beyond that point, that you're wrong in your assessment of the market and you need to either stop the trade out or hedge it. Pretty simple. Every trade should have a clear invalidation point. It's not an emotional threshold. It's not that you're being stretched to the point of no return, that you can't bear it anymore, that the losses are too huge. If you got to that point, you've gone too far. So it's not an emotional threshold. It's a technical or fundamental threshold that you may have assessed on your chart or what's happening in the sort of broader market. This is a no longer makes sense point on the chart or in the market or in the fundamentals. Sometimes, OPEC might just cut production or increase production, whatever it might be, in the oil market, and that may affect the price and that may affect your trading decisions too. So as I said, this is a no longer makes sense point on the market or in the fundamentals, and this is where hedging and not panicking comes in. Now, I'll talk about hedging very briefly here, but I don't have time to cover it. I do cover it extensively in my Swing Trading Blueprint course and in my natural gas trading course. If you're interested in hedging and how to do it, I consider this to be an essential part of every trader's arsenal, absolutely essential. And if you don't know how to do it, I suggest you get one of those courses from me. Instead of hard stops, use counter trades to balance risk. Particularly useful in macro positions, for example, natural gas, when, for example, the setup is long, but the price is tanking. And we can then short a correlated or take an inverse position to neutralize exposure on the same instrument. So hedging in the way I do it, and you can hedge in different ways using options and other methods, other correlated instruments. But the way I do it most of the time is I take an opposite position on the same instrument, on the same trading account with the same broker. Now, if you can't hedge, if you're not allowed to in your country, you can do it with different brokers or different accounts, and you can figure out a way to do it. But hedging avoids all sorts of problems, emotional problems, decision-making problems, technical problems on your charts, whatever it might be. Hedging is a really, really important skill to employ. And I'd go as far as to say that if you don't know how to hedge, or if you don't hedge, or if you haven't heard of hedging, or you're not allowed to hedge in the country that you're trading, you're missing out on probably one of the most vital parts of risk management in your trading. So think about it, consider learning how to hedge, and if you don't know how to do it, you can get one of my trading courses. The Swing Trading Blueprint talks about hedging a lot. At the same time, however, we need to avoid over-leveraging, and leveraging magnifies your skill and your stupidity sometimes. So size kills. Trade small enough to be wrong several times in a row. I normally allow for 10 times in a row. I'd like to be able to be wrong, get a trade wrong 10 times in a row. So 10 trades in a row at a 1% loss is 10% drawdown. 10 trades in a row at 2% loss is a 20% drawdown. And I think that's a reasonable amount to expect in an extreme clustering, losing environment, which we don't want to happen too often. Scenario planning. Have a plan for multiple market moods, trending, chopping, breaking news, liquidity events, ranging markets. Markets move in all sorts of different moods and environments and setups and structures as time goes on. And I think that's part of the skill of learning how to trade, is assessing which mood the market's in and being able to trade it accordingly. Whether you're a range trader, swing trader, day trader, whatever it might be, it helps to know what sort of phase the market's in. And then number 4, trading psychology, the inner arena, what's going on in your head. Ego is not your edge. Don't be proud, don't be brave, don't be overconfident. Don't be arrogant. Don't think that you know more than most people know yourself. I've been trading for 30 years, and I still assume that there are loads and loads of people who know much, much more than I do about trading. So, ego is not your edge. Overconfidence leads to size increases right before a regime change or a market change. And humility keeps you safe. Confidence in process and not prediction. Don't try and predict the market. Try and react to the market, as you probably heard many, many times from many people. Emotional mastery, the fight or flight instinct in all humans leads to revenge trades, overtrading, and stubbornness. Cultivate mindfulness, observe yourself as you trade, and use journaling. Be the analyst of the trader. The trader is reactive, the analyst is reflective. You need to be both. Review every trade. Note not just a price action, but an emotional action. We want to be obviously avoiding those fear, hesitation, greed, all of those negative emotions. You want to be able to identify those when they occur, or in hindsight, look back and say, yeah, I made that trade. It was a terrible mistake, but it was because I was emotional, or I was proud, or I was arrogant, or I was afraid, or whatever it might be. You want to try and avoid all of that. And number 5, process V prediction. Setups, not wishes. Only enter trades with very clear technical or fundamental rationale. Avoid impulse trades based on headlines or FOMO. Record setups, entries, rationale, emotional state. Review monthly. Look for patterns in behavior. And remember, no trade equals a position. Sitting out is an active decision, and I do this quite often. Sideways markets, unclear trends, mental fatigue. Cash is your best position. Number 6, building an edge brick by brick. Layered confidence. Combine market structure, dynamics, macro news, price action, and the more aligned the signals, the more confident the trade. When everything lines up, you may want to add some more size, pull the trigger a little bit more eagerly, and get into the market with a bit more enthusiasm, vigor, and maybe a little bit more size. And remember that size is not the most important dynamic. It's how much risk you're taking on the trade. In an excellent setup, you may be able to take more size, but at the same time, it's lower risk because you have a smaller stop loss, or it's just such a great setup that it's very high probability, and all sorts of reasons why you should adjust your trade size when you get in. If you're very, very confident, you might want to put some more on. You might want to get in a little earlier. You might want to consider adding more to the trade as it goes in your favor. You might want to add a little bit now and look to buy a little bit later on if you're buying in a bigger dip, something like that. But build up that layered confidence. Look for various things that all align: the fundamentals, the technicals, the price action, the sentiment, all the stuff that you see going on around you. Look for that layered confidence, and the more things that align at the same time, the more confidence you can take in your trade, and perhaps more size you can put on, and the more money you can make. Go through routine and ritual. Pre-market scan, key level mapping, daily brief, your own or in a group. If you're in a private group like mine, you can obviously interact with other people, bounce your ideas off others, and so on. And review trades. Even if you took no trade, it's a good idea to review the reasons why. And then trade in a community. And I really do believe in the solitary trading leads to blind spots, and I put myself in the same boat as everyone else. I like to trade within a community. There are a couple of communities that I semi-frequent, I suppose, including my own. And it's very, very useful just to have other traders around you. Solitary trading definitely leads to blind spots, so use your own trading room, test ideas, vent losses, share setups, and iron sharpens iron. And the final punch, the trader's code: stay alive. That's your first job. Keep your account liquid. Don't blow your account. That's your first job. If you can do that, you've done better than most people who enter the trading market. So don't blow your account. Stay alive. That's your first job. Be boring in the process and brilliant in execution. And size small, but think big. Never fall in love with a trade. Never marry a trade. And remember, consistency isn't sexy, but neither is losing your house. I hope you found this useful. And I just sort of recorded this quick video to go with these notes. And if I can just save one trader from losing their account through this process, then I've done a good job. Take care.